look at a few things. I wanted to point out that we have this RIOT trade on, and we have a number of different positions on in this trade. We have a covered call that we have bought 100 shares and we sold a call. The call now is at the 55 strike. You can see that this is trading over $67. So we're a little behind on that. Then we have some call spreads on with the 30 days to go. Let me show you how this looks, that we're going to be making some money on. So this is an in the money call spread, 2 points wide here. This is a in the money call spread, a long call spread that's 5 points wide. That's in the money there. So that is the most we can make on that is about $700 if both of those expire in the money, right? So that's not bad. They're not trading at that now. As we can show you here, if we were buying this back, this should be trading at 500. Let me hit clear so this can look right. You sell that, buy this, and you can see that this is only trading for $315 right now. So it's still almost $200 you can still make on that call spread because of volatility. Then we have in this RIOT, we have three put spreads, 2 contracts here and then 1 contract here that's out of the money now. We sold them in the money betting that RIOT will continue to go up, and it has. But what we're trying to think about now is doing a stock substitute. So buying back this covered call and then doing a doing a poor man's covered call. So right now, if we bought this back, this covered call, it's going to be about, let me hit this really quickly. It's going to be about $3,400 in credit, and then it's going to change our buying power by $2,100, right? So then what we would do is go in here and buy this 121, maybe buy something, maybe buy a call around this at the money area, this 65, and then go into the 30-day, and this is the poor man's covered call, and sell the front month. So that's the 65. We'll probably sell, let's say, this 85 and see if it goes up. And if we do that, that will change the game. If we do it like that, let me see, that would be a little bit less. So we're basically doing the same concept of the it's going to buying power wise, it's going to be same, but it's going to cost us a lot less. Actually, the buying power should change once we do that trade. So this should cost us about $1,400. That means that's the most we can lose if this falls out of bed, but we can still have some upside. So let's see if we can get filled in this without oh man, that's a bummer. This Russell is not being our friend this morning, which is a joy. But anyway, let's do this and see what we can get out of this really quickly. Let's see if we can sell this for a little higher than what it's going. It's jumping around quite a bit. So let's see what happens here. I'm going to take this up real quick to 50 really quickly, and let's see what happens. And that is, we can go to activity and see what happens here. Russell, it's fallen a little since we started. Let's try 35 really quickly, see if we can get filled. It's probably going to be tough, but we're trying to do the stock substitute here. Our short strike is only about 12 points away on the put side of this RTY. Didn't expect it to drop that much over the last 2 days, but it has. I thought the call side was going to be the problem. It's actually the put side, which is always that's what makes trading, difficult. Trading is not an easy game, because it could go in one direction for a long period of time, and then next it just really just falls out of bed pretty quickly. So we'll see. We had retail sales come out this morning that wasn't too bad, and so we're not getting filled on that. We got to let that sit. I want to do this on the call, so we can see. Let me move this down just a little bit. That's the 50. Let's move it down to 34.50. Maybe we'll get filled. And that's the 34.50. No love yet. All right, so let's just get robbed and do this here. This is what happens when it's very volatile with the stock. With the options, you can't really get out of it well, especially with that long dated one we're trying to do. So, and let me see here, trying to get out of that. Let's go 33. Let's go 33.90. See if that'll work for us. Actually, it's trading at 34. Yeah, 33.90. Let's try that. All right, so they gave us that out, and then now let's try to put back on the covered call here. We're going to do it at the money, so let's try to do the 60 here and buying the 60 strike, and let's sell the 80 strike. And if we do that, that's going to be about $1,400 to do, and let's see if we can get filled. All right, so let's put it in a little less than that. Let's see what happens. All right, so, and this is we put it in quite, I'll see, this is a debit, so we have to put it in more than that. Excuse me, everyone. All right, so we're going to put it in at the mid there. Let's go down to 14.90, see if that'll work. So that's not going to work. And we're going to put it in at 15. Let's put it in at 15.15, see if that'll work for us really quickly. All right, so that worked for us. So now we got on a covered call, excuse me, a poor man's covered call, and we just changed the ball game a little bit, use a little less capital with that trade. Okay, so we just gained ourselves another $1,000 in buying power to do that trade. All right, so looking at this now, we could adjust this R to Y, and for time purposes, we're not going to do this on the call. We just wanted to show that that changing, or it's called a stock replacement. We bought back the covered call that we had the shares in, and then we put on a poor man's covered call to be able to benefit as that continues to go up. So what would happen, everyone, if this call, we can go over to RIOT real quickly. If this call right here, this call with the 30 days to go expires out of the money, which is at the 80 strike now, then we will collect all of that money. And then what we would do is sell another call, and I just say whenever that day is, maybe 43 days, maybe whatever the new monthly one they put in. They'll put in a new monthly one for April, because right here, this April one is a weekly, so they put in a new monthly one. So we'll probably sell a call at that point, and whatever call that we sell, it's going to be higher than what we bought at, right? So, because that's a covered call. So we bought at the 60 on the call here, right? So whatever call we sell at next time will be higher. So maybe next time we'll sell at the 90 call. So that means we'll get, if somehow we get called away, we're probably not, because we're going to keep rolling it out, because we think this might go over 100, maybe even 200. We will, but if we did get called out, that would be 30 points there, right? So 100 times 30, that'd be another $3,000 that we make on this trade just from that type of trade. All right. All right. So it's a stock replacement, but you still got all the same upside. Okay. All the same upside, but just cheaper because you're just using options. And if it all falls out of bed, you lock in what you win. So a number of you should try this type of strategy. That you have some things that are really up a significant amount. You can replace it, and then you can lock in some gains, because the most you can lose on, once you turn it into a poor man's covered call or a stock replacement type of thing, the most you can lose is what you paid for. Okay, that's the most you can lose at that point. Until then, obviously, you can lose more. All right, so let's open it up for any questions that we have this morning before we conclude. Any questions do we have about anything I just showed, or anything I know